Hello, it's ChewDog Charts. After the opening bell on Tuesday, the Dow was down about 530 points or 2.3%. The S&P 500 was down about 49 points or 1.8%, and the Nasdaq was down 137 points or 2%. Within minutes, however, stocks rallied back sharply with the Dow rising as many as 300 points before moving back into the red later in the morning. Overnight, markets in Japan and Australia each lost more than 3%, with the Nikkei in Japan falling 5%. Meanwhile, stocks in Europe were lower across the board, with the Euro Stoxx 50 closing down almost 3%, the DAX in Germany falling almost 4%, the CAC in Paris down over 2%, and London's FTSE 100 off 6%. On Monday, the Dow lost 1,175 points, the largest point decline in the index's history and good for about 4.6% loss. The S&P 500 on Monday lost 4.1% or 113 points, and the Nasdaq fell 3.8% or 273 points. These losses followed a sharp decline into the weekend on Friday, with investors pointing to a number of factors as the source of the move lower in markets. So what's going on? Well, let's take a look. So the story of what happened is that following Monday's sell-off, many in the markets were pointing to the massive surge in the VIX. The VIX is the index which tracks market volatility, and we've talked about it before. And with regard to the VIX, there was an implosion of an ETN, or an exchange traded note, which seeks to expose the investors to the inverse of the VIX. So early Tuesday morning, the VIX was trading above 50 for the first time since about August 2015, when markets sold off on concerns related to the Chinese economy. Now, earlier this year, the VIX was well below 10, so that's a huge difference. So on Tuesday, Credit Suisse, which sponsors the XIV ETF that tracks the inverse of the VIX, said it would redeem the note after an 80% decline after hours on Monday. And in the chart, you can see on the far right the 4 p.m. line. So that move happened after hours. And the XIV holders will get a cash payout on February 21st as a result of this action, and this redemption will likely trigger massive losses. So we haven't seen it all yet. So a little bit more background information is the VIX market saw the biggest net buying pressure on record. According to Morgan Stanley, ETPs had to buy 282,000 VIX futures to rebalance their short gamma. So this was the largest VIX buy in history, which dwarfed Friday's previous record of 78,000 VIX futures. And since most of the rally in the VIX futures happened after that 4 p.m. cash close, there was no time for investors or issuers of the VIX ETPs to react. And the amount of volatility to buy well exceeded the bank's estimates. So in short, what happened is holders of the inverse ETPs lost about 3.4 billion overnight. And then also as a result, Credit Suisse called it game over for that inverse ETF. So my suspicion is as a result, there's going to be some further ramifications down the line. So again, another caution, let's sit on the sideline and let's continue to be patient. Let's take a look at some other news. And the additional news is that the Fed isn't going to dilly-dally around any longer. And just this afternoon, we got the Fed's balance sheet for the week ending January 31st. And the so-called balance sheet normalization, which impacts two types of assets, the Treasury securities and the mortgage-backed securities, and we'll call the mortgage-backed securities MBSs. And that's what the Fed acquired during the years of quantitative easing. Now, the Fed's plan, as announced in September, was to shrink the balance of the Treasuries and the MBSs by up to $10 billion per month in October, November, and December of 2017, and then to accelerate that pace every 3 months. So in January, February, March of 2018, the unwind would be capped at $20 billion a month, in the second quarter at $30 billion a month, in the third quarter at $40 billion a month, and then starting in the fourth quarter at $50 billion a month. And according to the plan, the balances of treasuries and MBSs will shrink by $420 billion in 2018, $600 billion in 2019, and then by an additional $600 billion every year going forward until the Fed deems that the level of its holdings is normal. So for January, the plan called for shedding up to $20 billion. That would be $12 billion in treasuries and $8 billion in MBSs. And we now have the results. So how did it go? As of December 27th, the balance sheet, the Fed had $2.454 trillion of treasuries. And by January 31st of 2018, it showed $2.436 trillion. So that's a drop of $18 billion in 1 month. Now that exceeds the planned drop of $12 billion for January. So at least we know that first, they're ahead of schedule, and second, they're actually trying to unwind. So this unwinding is going to bring more product to the financial markets. So look, we've got a number of things going on. We're having some strong volatility here, and then we also have the QE unwind. So that's going to have some huge implications for the stock and bond market. It's not a time to be in there playing around. It's starting to get serious. So once again, I'm advising caution. Sit on the sidelines, keep collecting that cash for opportunities, and be cautious. So for today, that's ChewDog Charts. Thank you.